Hi, everyone. Welcome to another episode of Real Estate Investing with Anna and Peter. My name is Anna Tan.
And I'm Peter.
So today we're going to talk a little bit about a market update in the Texas market, and we'll go ahead and get started. So just a quick disclaimer. So the views and opinions expressed are provided for informational purposes and should not be construed as an offer to buy or sell any securities or to make or consider an investment. If you have any questions, please visit our website for more information. So what we'll cover today, a little bit about us, the Texas market and multifamily, and some of the cap rates and what our response is to today's market. First, a little bit about us. So we started multifamily, a Sweet Life multifamily, to empower our friends and family with the knowledge to build wealth through real estate and bring opportunities to build passive income to you. So we've been investing in real estate for the last 10 years. We currently own a small portfolio of single family homes, which have been doing really well, over 20% cash on cash returns and over 56% annualized returns. We've tried a couple of different other venues in terms of the real estate investing space. And now after 10 years, we've landed to multifamily and we are absolutely loving it. And we hope you will enjoy it too. So what do we do in the multifamily? What we employ is the value add strategy. We basically look for opportunities to improve the current multifamily units, whether it's through kitchen upgrades, the flooring or whatnot. And we're seeking areas that will generate the highest increase in rent. So what this does is it increases the NOI, or the net operating income, therefore increasing the monthly cash flow and the distributions to our investors, and increases the value of the property at sale. Now, so what do I mean by that? So here's a quick example of a kitchen. You have a classic and an updated unit. This is the same exact kitchen, same floor plan, but look at the difference after the remodel. Now, would you pay a little bit more for the updated version? I would. So pretend that you have an option to go for the updated unit. You pay $100 more a month for a unit like this. So multiply that by 12 months. So one of these units, $100 times 12 months, you have an increase in $1,200 a year for this upgraded unit. Now multiply that in multifamily. So if we have 100 units, multiply that by 1,200, you get $120,000 increase in NOI. So at the end of the day, you have to remember that multifamily is a type of business. It's commercial real estate. So when you increase the income, you're also increasing the value of the property. So upon disposition or upon sale of the property, you make a little bit more money. So that's why we try to employ a value add strategy.
Yeah, Anna, just to add a little more to that, if you just go back to that last slide, cap rates are around 4-5% right now, or actually they've compressed even more. So at a 4 cap, a 4 cap rate, $120,000 increase in NOI is $3 million increase in the value of that commercial property. So this is why we use the value add strategy, because you can greatly increase the value of the property and deliver those returns to investors. So I'm going to go ahead and give us a little bit of an update on the Texas market. We've been really active over the last several months in the 2022, and we've been watching the market very closely. And I wanted to share some data on the on employment, population growth in Texas. So first off, we've since the pandemic, dip in the pandemic in terms of employment, we've recovered all of those jobs in Texas overall. And population in Texas is continuing to grow. Here over the last 30 years, that trend has continued, and we're seeing it start to accelerate. Austin, Dallas, and Houston have been part of the top 10 markets in terms of population growth and also rent growth. So next slide. And, we've been really focused on the Houston market. So I kind of want to give you guys an idea of what we're seeing in the Houston market. And in order to explain it really well, I wanted to take a snapshot of what's going on in the single family space. Okay, so just looking at single family homes, over the last 10 years or 20 years, home prices have doubled. They've actually, and over the last couple years, they've really accelerated. And what's going on is, we have a large net migration of people moving into Texas, and they're snapping up homes, okay? And the bottom tier, your low tier and mid tier homes have taken the largest jump in prices. So what that does is it makes it really difficult for new home owners to jump into a house right now. And what that's doing is it's forcing people to rent. If you can't get into a single family home, you're going to look for alternatives, and that's really benefiting the commercial multifamily space. So what we're seeing in the market right now is very, very high demand for multifamily. And we don't see this letting up anytime soon. So what we have right now is a restrictions in terms of labor, material, and so that's gonna really, that's slowing down new supply into the market, and it's keeping these prices high.
Just to expand on that, if you look at the bottom graph where you see the low tier price index is much higher than the others. So the low tier price index is the more affordable homes. And if you kind of think about if the first time home buyers aren't able to afford the low tier, the more affordable homes, they're going to go into the multifamily space where it's a little bit more affordable compared to the single family home.
Yeah, absolutely, Anna. And here's just to kind of illustrate that picture a little bit further. And this is this is a picture of the current inventory in Houston. And this graph looks exactly the same for Dallas and Austin, except they're actually tighter in those markets. But right now in Houston, we have 1.3 months of inventory. And that is the lowest it's ever been. And a balanced market is somewhere between 4 and 6 months of inventory. Okay, that means there's even a fair amount of inventory where it's not crazy or it's not like a recession. But I mean, right now there's almost no inventory. It's very, very difficult to get into a home. All right. So with the low inventory in that single family market space, like I said, vacancy in your multifamily, your apartment complexes, they're coming down. So over the last 2 years, we've saw a 250 basis point decrease in vacancy, 2.5% decrease in vacancy, which is a lot. So Houston, San Antonio, Dallas, Austin, we're all around that 250 basis point decrease in vacancy. You got San Francisco, which is an outlier. Okay, so a lot of people moved out of San Francisco and now they're all moving back in. So that's why you have this big jump in vacancy change. That explains San Francisco down there on the bottom of the graph. And then you have Austin, and Florida kind of leading the way in terms of rent growth, 25, 30% rent growth. But Houston, San Antonio, and Dallas are still great places to invest. We're seeing, over the last 2 years, 15 to 20% rent growth. And then we're projecting here in 2022, anywhere between 5 and 10% in Houston and Dallas. So these are still really good places to invest. rents are going up because, like I said, people are still moving to Texas, and we really like Houston. So why am I bullish on Houston? Well, the energy market is turning around. You know, Houston's become a pretty diversified city in terms of industries, but a large part of it is still energy. And with oil prices near $100 and peaking, well over $100 a couple of weeks ago, jobs are going to return to Houston, and you're going to see that momentum, you know, continue to drive Houston's economy over the next several years. So we really like Houston.
And Houston is still very affordable in terms of real estate opportunities, especially when you compare it across Austin. If you are familiar with the Texas market, you know Austin is incredibly difficult to enter. So Houston is still very affordable, and you can still make great returns.
One of the things that people are talking about right now are like Russia and Ukraine, and there's a war going on out there, and it's a big humanitarian crisis. It's really sad to see what's going out there, but we really want to want our investors to understand that the events over there are not going to impact, commercial real estate. Real estate is a great safe haven, a great inflation hedge, and the war over there has very limited impacts on real estate. If anything, from an economic perspective, it's going to help Houston. All right. So again, Houston is the energy capital of the world, and the sanctions against Russia, limiting oil supply and gas supply in Russia, is going to drive energy prices north. And that is going to, in turn, improve jobs, increase the number of jobs in Houston over the next several years, especially with Europe looking to detach from gas supplies in Russia. That's going to really drive energy demands from other countries, and the U.S. is going to benefit from that. And Houston is going to be a major part in that energy transition. So let's talk a little bit about cap rates. We've been really active. We've been working diligently to acquire properties. And what we're seeing in the market is cap rates are continuing to compress. So here's some data that we've dug up. As you can see, cap rates have gone, average cap rates, and this is across all classes, have come down from like 5% into the 4.5%. And we've seen it dip even more in highly desirable areas and submarkets. So right now we're seeing caps, around 4%. And the reason for that is, like I said, real estate is a great inflation hedge, and it's a safe asset. So when you have geopolitical risk out, in Europe, war going on, people are fleeing. You got dollars looking for hard assets they can put their money in. So in an uncertain environment, hard assets are more valuable. And then inflation is running hot right now. It's 8% over the last 12 months. They anticipate that to continue to increase through 2022. And with the war going on, energy prices are continuing to increase. So inflation is going to continue to move north here in 2022. So real estate, again, a great inflation hedge, is going to help, is going to be a great asset to hold. And so guys, what are we doing with cap rates coming down? So what we're seeing is that, the spread between the cap rates for A class, B class, and C class, they've really compressed. So you can get a C class for a 4.5 cap, or an A class for a 4 cap or 3.5 cap, around a 4 cap. And, we kind of want to tell you, share a story here. we were trying to acquire a property in Houston. This is a solid C-class property in a very strong demographic, it's a very strong submarket. We bid it on this property at about a 4.5 cap. Okay, it ended up going for a 4.3 cap. But across the street, you could get an A-class property for a 4.1 cap. I mean, would you like a 1979 property or a 2000 property for almost the same returns? We're just not seeing, the market is not compensating investors for the additional risks that they're taking on with C-class properties. So what we're doing is we're now targeting newer properties with less risk, and I mean that's a strategy that we're kind of pivoting on now. The other thing is that we want to target submarkets and areas with higher household income, so over $50,000. And the reason we're doing that is that as inflation rages on, it really hits the poor much worse. So your higher income households are going to be able to absorb some of the inflation, but your lower income households are really going to be hit very, very hard with rising costs in terms of food, housing, utilities, transportation, and they're not going to be able to absorb the rent increases from our apartments.
So if this was interesting to you and you're invested in future opportunities with us, connect with us on our website, get your smartphone, take a picture of that QR code, log into or subscribe to our newsletter, and you won't miss out on our next opportunity. Thanks for joining in.
Thanks.